Back to B Grade Economics. This is Nate. Hey, so this is going to be my weekly market update. Sorry, dog's whining at me. And we're just going to cover a couple of stocks and a couple of my thoughts on them. Again, I'm not a professional trader. None of this is financial advice. I'm just some guy trying to manage his risk. So the S&P 500 overall has reacted mostly to the chaos that's ensued following Federal Reserve high inflation response verbiage. I won't necessarily call it policy because policy usually gets enacted, and I have my doubts. That said, the S&P 500 probably is showing some reasonable bottoming actions. We're seeing like a pretty acceptable trend here. I'm not going to say that this is going to be some up-only recovery and everything's going to be all right. We're not out of the woods yet, but if you were looking to watch yourself for caution, it's a pretty easy thing here to just look at this high over here back in September or August and then bring it over to now. If we break below and print below, right, we had this one high candle here that was scary, and then we gapped up, right? If we wick below, break below, and print below, and we're looking bearish, might be concerned. Now, that said, the RSI is descending, right? Even though price has ascended. The MACD is descending and giving us bearish prints. I think that we have some more downside to go, but we're still within the long-term, almost 2-year channel here. I don't think we're just going to just crash and go down only from here. I think we'll probably come back down and retest. Maybe we reset and move sideways so we don't necessarily crash, right? This is the market trying to suss out where it's got to go from here. Everyone's calling for a Santa Claus rally. Maybe we get it into here. We get another top. If you get, we've got 3 tests of this top. We got 2 tests of this wick here. If we get another one anywhere up here and then come back down, I'd be concerned because we'd be spending some time in the mud. Maybe we end up sideways and it doesn't work out too well. Now the volatility has already spiked and we have a trend going here on the VIX of breaking it, but we also have some resistance to come back up into. And I get the feeling that we're not just going to see a violent, 30% crash in the short term. Maybe it comes later. I don't know. But what I do know is that the risk is higher here. And so what I'd be watching for is just whether or not you get these prints below these lines to see if it's going to go any lower. Realistically, until you're out of this channel, there's not much you really should be reasonably doing here because this is within the average mean, right? More volatility here, but it's within the mean of the range. We're in the middle, right? So it's really not that bad of a scenario as much as people are trying to talk about double tops and a big bear market coming. There's a lot of fear in the market already, and usually these crash with complacency. So over here you can see I've got a lot of chaos on this slide. This is the QQQ, the Nasdaq ETF, and I tracked everything that occurred throughout the past 2 years in terms of like stimulus and reasons to be bullish in terms of government response, right? I was trying to account for monetary and fiscal policy. And we see that it's generally fed a lot of the response here. There hasn't been a lot of bearish reasons from the government. And we had this Rick Astley QE back August, September, October, where we were like, yeah, QE is never going to end. We're never going to stop getting stuff paid for. And then high inflation prints started getting this like response of, oh, the Fed may have realized that they're kind of late to the party on the inflation game. So people may think that the Nasdaq is a bubble and is going to crash, and I would agree that it is a form of bubble, but it necessarily crashing from here isn't guaranteed because one, the Fed has a tendency to step in whenever we go below 20%, down 20%, and the other reason is this. This is the Nasdaq pricing shares of the S&P, and how many shares of the S&P can the Nasdaq purchase? We see the .com bubble. This was the true bubble, right? But overall, we should expect technology to ascend here. We should generally be bullish that technology is replacing a lot of our daily life function, and we all need it. And so we should anticipate that the stock market should reflect some of those expectations. And so we might be into a level of exuberance, but I highlight that this is a very similar trend we're seeing. Now, that said, do I think that we get the exact same ratio length here? Probably not. I just don't see the Nasdaq. Yeah, while it will always surprise you in a bubble, right? I don't see the Nasdaq pricing in literally twice the S&P 500 in the next 6 months, Probably not, but we could see it jump to 4 or 5. And that wouldn't necessarily surprise too many bulls out here, but it also would indicate that we still had a blow off top, and so maybe we see a descent somewhere into this range. Historically, we did this last point test, came up, hit our zone of confluence, blow off top, fail to make a second high, fall down, fall below the zone of confluence, and then just go back to the last point of supply. So if we went to the last point of supply, I estimate to be here. It could also be here. That's just things to consider, is that the ratio of Nasdaq to S&P might shift. Now, if the Federal Reserve targets its policy as it thinks correctly, then maybe we just see inflation eat away at some of these gains and people kind of calm down the stock market and we see a little bit more of a fade. I think that's what they want to see, is they want to see prices rise but the bubble fade. And that would just mean coming a little sideways here. I just don't think policy is going to meet human action as accurately as they want. So here's the U.S. government bond 10-year, and I talked in a video about the 1940s and how we had yield curve control, and yet the bonds still got bought up below the yield curve control because of shortages, right? This was fears early on in 2020 and into 2021. We started going into risk on, and then we went into a little bit of risk off as we realized that we had a new fear, the second wave coming in from the new variant. And then we started seeing a bit more of an inflation trade, and then the realization that inflation was going to trigger Fed policy. So comically, we were getting ready for inflation and then prepared for deflation here. And so I've tracked that, pretty well on my channel so far. But what I want to indicate is that even though we're having a breakout, I can't tell you that this is necessarily us getting ready for inflation. The euro-dollar system it has inverted along with the long end of the bond yield curve. And so that to me means that there's more fear in the bond market still. So to alleviate this fear, you're going to have to do something to print some money, pump some money into the system, get some people excited and exuberant. And we've already had 2 years of exuberance, so it takes a lot more of the drug to keep you excited. So it's just things to consider, is that we really just don't know. And I think this is a fear bubble and the stock market is a euphoria bubble. And so I think we're just running into two bubbles heads where they've got to deflate somewhere. And so in order to deflate this one, the fears are going to have to be alleviated, and that's going to have to be through not necessarily a blow off top. I mean, it's just going to have to be through making people confident that the Fed's policy isn't going to cause the crash. So when we get to precious metals, I want to highlight this. This is the S&P 500 priced in gold, priced in silver, priced in copper. And you see this trend where they kind of weave between each other. Copper tended to take the lead in the commodities bull market. At first, you kind of got gold and silver dragging in, and then you got the copper market indicating that it was preparing for higher energy costs, higher productivity expectations at the same time. And then you had 2008 financial crisis, and it switched, and copper underperformed due to lower industrial demand, while gold and silver ripped, and silver beat them all, right? I'm expecting silver to beat them all because I'm expecting industrial metals to still be necessary. So in silver and copper to outperform gold this next time around, because instead of having necessarily a market crash and a recession, I expect that the Fed, based off of how I've read policy, how I have read the history of economic responses and stimulus from 1929 to now, the Federal Reserve truly believes that it needs to do more than it did last time. And every single time it said the same thing about the last time. We didn't do enough, we didn't do enough, we didn't do enough. So the next time is going to be more, right? They're just going to stimulate more because they're not going to believe in this unfairness statement of, well, we shouldn't bail out homeowners like they said here. I mean, the guy who orchestrated the bank bailout said he wasn't confident in the necessity to bail out individual homeowners because Americans would think that was unfair, and he thought that that was actually the wrong decision as an afterthought. So what do you think is going to happen if we do have some type of default? They're going to bail out everybody, right? That's the mindset now in the Federal Reserve. That's just how the policy works, and it's not to necessarily say that it's inherently evil, but it's going to have consequences, and these consequences are going to result in higher precious metal prices to the S&P 500, even if the S&P 500 is still roaring, right? And that'll be the impressive part, is if the S&P 500 goes up 50% over the next 3 years, or 30% over the next 3 years, but precious metals rip even more because the yields aren't beating inflation. You're going to start seeing some differences here. Also, bonds, if they continue to be suppressed, are going to have to bleed out into it. So, but here's gold, and mostly what I indicate is simply that we had this plunge, we had a breakout, we're retesting back down. Seasonally, you should expect that you should see a downside at the end of November and then come back up to an upside into the end of January. I just don't know how strong this is going to be yet because we really need to see what the rest of the stock market and the bond market's going to do. So like I said, it's really driven by this macro view at this point. Silver, we're in this Wyckoff accumulation. Now, this is giving me some predictive focus on the long term because it just seems to line up so well so far. But the SILJ is indicating a recovery, gold is indicating a recovery, and silver is indicating a recovery. And since seasonality, the history of silver shows that we have a 78% chance of an upside from the end of November to the end of January. And that upside averages 2.73. Sorry, I only got 2.74 here, but 2.73% return from that point. So from that point, that's what you're looking at. So right now, statistically, you have a chance of actually averaging a higher return here from here. So in the short-term trade, I think this plays out. That we're breaking out of our downtrend of RSI. We're seeing an uptrend in the MACD. So at a minimum, we could see a healthy kind of setting in stable prices. Maybe we lose some of this volatility and we get lower into these bands here finally. But that brings me to the next projection. If this is Wyckoff accumulation, there's two types of accumulation here. You have type 1 and type 2. I don't think this is a W bottom necessarily. If it is, you're going to have to see a setup here where you're going to get higher prices and then just keep setting up above 25.50, and then we might be off to the races. I don't think that happens. I think what's more likely to happen is you see the stock market continue to perform, and then you start seeing the market realize that either the bond market has to outflow, the stock market's in a bubble, or the bubble of the stock market has to outflow, and bonds are too expensive. So either way, you get cornered and you say, I need something else to store my money in, precious metals. So if we just have an inflation concern, bubble concern, we could see this low point of supply. And this is the macro kind of narrative I want to highlight here, is that if we just have concerns that we're not going to get good returns throwing all our money into stocks, then we probably just see this, right? Where we just kind of like realize that this was the bottom and it's time to just start accumulating, and that alone pushes us up. But that's a more natural response. What I think is also possible, and this is what concerns me, if I set this up right, then that means that we're going to see a dip in phase C, a spring, right? And that spring should break both of these lows. So we could see it go all the way down to like a historic support line or resistance line, 1962, and this goes all the way back to 2006. So if we have this support line get tested, and there's this big gap here, what happens? Well, to cause that, it's probably some type of liquidation event. And that's what concerns me, is that maybe this is telling me, hey, the market is indicating this is accumulation. It doesn't know what's going to happen, but if one of these happen, we either get a crash or we get a realization that the inflation is just too much to bear, and so the cost of even the precious metals has to go up, right? Bringing me to Bitcoin in terms of precious metals and monetary assets. Bitcoin, I think, is going to continue to perform. We broke out of the RSI downtrend here just ever so slightly. We are seeing the MACD flip after a very long bearish term here. This is the longest span that we've gotten bearish MACD signals the entire time. So this is for like since like 2019. So this is a good sign that we're getting some strong signals here. That doesn't necessarily mean that we go into a blow off top, but or we go to like 100K next week, you know. But we probably see us recover somewhere into here. And what I would say is that a strong green candle breaking us out of here would be great. Retesting, resuming, retesting, resuming. That's the healthiest way to get out of this, because it would keep the RSI low enough that we have enough gas in the tank to keep moving. But if our macro plan plays out with a crash and we do go into a kind of a new rise, maybe we hit 70K and then we start declining with the rest of the stock market as they prepare for the crash, which means that the metals sell off, which means Bitcoin sells off, right? And you all have probably heard my thesis argument is that Bitcoin is already performing as a free market monetary hedge, which means that if it crashes, it's probably going to dip pretty hard because of the volatility expectation, but it's also probably going to recover much stronger than people are willing to accept. Ethereum, however, trades a lot more like the Nasdaq, and so even though people may flee to it, I'm not seeing that in the trend. So this is Ethereum priced in Bitcoin, and we're really seeing these moves more mimic the Nasdaq since right around here in October or here in September. It is still a limited supply asset, so there may be reasons for it to pump anyways following a crash. But in terms of response, if you're going to see the Nasdaq go up, you're going to see Ethereum keep moving. And there's enough gas in the tank here on the RSI. There's enough momentum ready to be built, but we do still have the MACD problem that we have in the Nasdaq and the S&P, is that we may see a general decline in the momentum. And I think that sets up Bitcoin again to kind of move better on that inflation response. So the tech traders kind of pull some liquidity out of Ethereum in order to go heavier on Bitcoin as part of a kind of a hedging aspect, which is neat to say the least, to see it perform like that here. But again, back to my macro thesis from what I've studied from 1929 till now, looking at including Britain, their bond market yields throughout World War II, and looking at the 1970s, looking at how inflationary markets respond. I think that I have a general understanding of how this should play out. But again, these are not necessarily nominal prices response. These are relative to valuations of each other. So the stock market could just decline compared to gold so rapidly, right? And so that would also mean that if you want to leverage your opportunity, you do gold, you do silver, you do Bitcoin, you choose how you want to do those leverages. And then you can look at like miners and see how those are going to give you, and that includes Bitcoin miners, like how much are you going to be levered into this? And then the problem is, if it's a real stock market crash, maybe you don't focus so much on the stocks and you focus on the monetary asset. If it's a inflationary depression where you're going to get less productivity and less real returns, then maybe you do focus on those stocks because those stocks are going to be bought up as an inflation hedge. But just to cover again that the Federal Reserve has a tendency to cause or lead into, not necessarily cause them, but they tend to be a trigger for starting bubbles with loose monetary policy, and then they try to taper it, try to reduce the monetary policy, try to raise rates. And historically, the market has not liked them raising rates even more and more, and so they've gotten softer and softer on policy, and so they just keep feeding these kind of bubble responses. This was the housing bubble, the tech bubble. This is now the quote unquote everything bubble, and now we're into a whole new COVID bubble. So I would just pay attention to the fact that people are out there saying that they can't taper. I would highlight that can't, meaning unable to do it in a manner that would not allow the government to default. Doesn't mean that they won't do something for a short period of time that doesn't lead to a problem. So one last thing, I had a friend highlight to me the disparity in the claims that everybody is just on unemployment and lazy millennials. I disagree with this sentiment, and here's why. And he pointed this out pretty strongly, is that realistically, America has a retiree problem, not an unemployed under 40 worker problem. We have a high rate of retirement and people living to around 80. Not only that, but we've seen that the trend for the retirees as projected for the boomers to taper is not happening. We're getting even more retirees faster. And while people want to claim that the stock market going really parabolic has given millennials the ability to retire, I disagree. I think I'm pretty reasonable at managing my money, and I can't retire just yet because I played crypto pretty sensibly, and I'm still not a millionaire. So I'm gonna say that the waitress at IHOP is not a millionaire, nor is the McDonald's burger flipper, right? Like, yes, there are cases, but how many of them do you truly know? There might be people leaving their job feeling confident that they can step out, but also that wealth may not be lasting. So the retirees as a percent of US population, I think, is more a trend indicator that the elderly are retiring a little earlier, a little faster, because they got 28 and 26% returns on the S&P 500 over the past 2 years. So I think there's a higher likelihood that we just have gotten this really high response. And so unemployment will be down, but that's because retirees are no longer part of the available working force. And so we may just see that really it's the lazy boomers trying to retire at 60 instead of 65. How dare they? But it is a top-heavy problem, and so we are getting more and more the reason for stimulus being this high voting population also needing to keep their stock market returns so that they can actually feel confident retire and not become a saver and cause low velocity. So just things to think about on the macro scale of how 2009 was around the time that boomers were going to start uptrending, and we had the market crash, and then from there we've been protecting the stock market nonstop. So, but yeah, thanks for watching. I hope to see you again. Continue to follow my channel. I will provide at least weekly updates. I like Tuesdays because the market kind of calms down after Monday and we don't necessarily see that crazy gap of chaos on Friday. So Tuesday afternoons are a good day for me to keep doing this. So I'll see you again.